Welcome to this study guide for the Texas Life Insurance exam. Before we jump in, let's be very clear about the purpose of this video. This is not a general life insurance review. We're focusing only on the material that is specific to Texas law and Texas regulations. Quick reminder on how the exam itself is structured. The life insurance exam is divided into two parts. One part covers general life insurance concepts that are mostly the same no matter what state you're in. The other part is the state portion, which tests your knowledge of Texas-specific rules, definitions, and licensing requirements. Everything you hear in this video applies only to Texas. Because of that, this video works best as a supplement, not a starting point. You'll want to already be comfortable with the core life insurance concepts, things like policy types, riders, underwriting, and basic contract rules. If you need that foundation, check out the rest of the My Insurance Guide channel videos, where there are non-state-specific life insurance study guides that break everything down in a clear, exam-focused way. Once you have those fundamentals locked in, the Texas-specific material becomes much easier to understand and memorize. Think of this video as your shortcut through the state section. We'll focus on what Texas expects you to know, how the questions are usually framed, and what details are most likely to show up on exam day. Texas Department of Insurance, TDI Overview. The Texas Department of Insurance, often called the TDI, is the state agency responsible for regulating the insurance industry in Texas. Its main job is to make sure insurance companies, agents, and policies all comply with Texas law, and that consumers are treated fairly. At the top of the department is the Commissioner of Insurance. In Texas, the Commissioner is appointed by the governor and serves as the chief insurance regulator for the state. The Commissioner's duties include enforcing the Texas Insurance Code, adopting rules and regulations, licensing insurance companies and agents, and taking disciplinary action when insurance laws are violated. The TDI itself has broad authority. It oversees insurance companies operating in Texas, approves policy forms and rates when required, licenses agents and adjusters, and investigates complaints. A major focus of the department is consumer protection. That means making sure policyholders understand their coverage, preventing unfair or deceptive practices, and stepping in when insurers or agents act improperly. The department also has strong enforcement powers. TDI can conduct investigations and audits, issue cease and desist orders, impose administrative penalties, suspend or revoke licenses, and refer cases for criminal prosecution when necessary. If an agent or insurer violates Texas insurance law, TDI is the agency that enforces the consequences. All of these rules and requirements are found in the Texas Insurance Code. The Insurance Code is the collection of statutes passed by the Texas legislature that govern insurance in the state. It's organized by subject, making it easier to locate laws related to specific types of insurance, licensing, or enforcement. In addition to the Insurance Code, there are administrative rules that come from TDI. These rules explain how the laws in the Insurance Code are applied in real-world situations. A helpful way to remember the difference is that statutes are the laws passed by lawmakers, while administrative rules are the detailed regulations created by the agency to carry out those laws. For the exam, you don't need to memorize where every rule is located, but you should understand that Texas insurance laws come from the Insurance Code, and the day-to-day regulations are created and enforced by the Texas Department of Insurance. Texas licensing requirements. Now let's talk about Texas licensing requirements. To apply for an insurance license in Texas, you must be at least 18 years old. That's the minimum age requirement for most insurance license types in the state. Texas does allow both residents and non-residents to hold a license, as long as all requirements are met. Before you can apply, Texas requires you to complete pre-licensing education. The number of hours depends on the license you're applying for. If you're applying for a combined general lines life, accident, and health license, Texas requires 40 hours of pre-licensing education. If you're applying for life only or accident and health only, the requirement is 20 hours for that specific line. Texas also requires fingerprinting and a background check for resident applicants. Fingerprints are used to run a criminal history check through the state and the FBI. This must be completed through an approved fingerprint vendor before the license can be issued. There is also a licensing fee. The exam won't test you on the exact dollar amounts, but you should know that Texas charges an application fee, and fingerprinting is a separate cost. Now let's talk about the different license types you'll see on the exam. The most common is the General Lines Life, Accident, and Health license. This allows an agent to sell life insurance, health insurance, and related products. Texas also offers a life-only license and an accident and health-only license, which limit the agent to selling coverage in those specific lines. Texas may also issue a temporary license in certain situations. A temporary license is typically issued when a licensed agent dies or becomes disabled, and someone needs short-term authority to continue servicing the business. These licenses are limited, usually valid for up to 90 days, are not renewable, and come with restrictions. Temporary license holders must operate under supervision and cannot exceed the authority granted by the temporary license. Once you're licensed, you must maintain that license. In Texas, licenses renew every 2 years based on your birth month. Renewal is not automatic, and it's the agent's responsibility to make sure everything is completed on time. Texas requires continuing education to renew an active license. Agents must complete 30 hours of continuing education during each 2-year renewal period. Out of those 30 hours, at least 2 hours must be ethics education. All continuing education must be completed through Texas-approved CE providers. Agents are also required to keep their information up to date. If you change your address, Texas law requires you to notify the Department of Insurance within 30 days. If your legal name changes, you must also notify the department and submit the required documentation. Texas does allow licenses to be placed on inactive status. An inactive license means you are not authorized to transact insurance, but you are also not fully terminated. This can be useful if you're stepping away temporarily and want to avoid reapplying from scratch later. Finally, let's cover non-resident licensing. Texas participates in reciprocity agreements with other states. If you are licensed and in good standing in your home state, Texas generally does not require you to complete pre-licensing education or take the Texas exam again for the same line of authority. Non-resident applicants must maintain an active license in their home state, and Texas licensing privileges depend on that license remaining in good standing. While many requirements are waived under reciprocity, non-residents must still comply with Texas insurance laws when conducting business in the state. Texas-specific product regulations. Now let's get into Texas-specific product regulations, because this is where the exam really starts to feel different from the general portion. Texas requires certain provisions to be included in all life insurance policies issued in the state. One of those is the grace period. In Texas, life insurance policies must provide a grace period of at least 30 days, and some policies may state 31 days. During this grace period, coverage stays in force even if the premium hasn't been paid yet. Texas also requires an incontestability period. After a life insurance policy has been in force for 2 years, the insurer generally cannot contest the policy based on misrepresentations made in the application, as long as those misstatements were not fraudulent. Another required provision deals with misstatement of age. If the insured's age was stated incorrectly on the application, Texas law allows the insurer to adjust the benefit amount to what the premium would have purchased at the correct age, rather than voiding the policy altogether. Texas policies also include a suicide clause. If the insured dies by suicide within the first 2 years of the policy, the insurer is typically required to refund premiums paid rather than paying the full death benefit. After 2 years, suicide is treated like any other covered cause of death. You may see questions referring to required policy provisions unique to Texas. The key idea is that Texas law is very specific about protecting policyholders, and insurers must include these provisions in their policies to remain compliant. Texas still tests industrial life insurance, even though it's much less common today. Industrial life insurance is typically characterized by small face amounts and premiums that are collected weekly or monthly, often directly by an agent. These policies were historically designed to cover burial or final expenses. Texas places limitations on industrial life insurance, including restrictions on face amount and requirements around premium collection methods. These policies must also include specific provisions designed to protect policyholders, similar to standard life insurance, but tailored to the smaller policy size and payment structure. Group life insurance in Texas has its own rules as well. Texas requires minimum participation levels for group policies to ensure they are legitimate group plans and not individual policies disguised as group coverage. These participation requirements vary depending on the type of group, but the goal is to spread risk across multiple insureds. Texas also provides specific conversion rights for group life insurance. When an individual loses group coverage due to termination of employment or eligibility, they have the right to convert their group coverage to an individual policy without evidence of insurability, as long as they apply within the required time frame. Group life policies issued in Texas must provide each insured individual with a certificate of insurance. This certificate outlines the coverage, beneficiaries, and key policy provisions. Texas also allows dependent coverage under group life insurance, subject to eligibility rules set by the policy. Viatical settlements are heavily regulated in Texas. A viatical settlement involves the sale of a life insurance policy by the policy owner to a third party, typically when the insured has a life-threatening or chronic illness. Texas law defines and regulates these transactions to protect vulnerable consumers. In Texas, viatical settlement providers must be licensed. There are strict disclosure requirements, including informing the policy owner of alternatives to viatication, the potential tax consequences, and the impact on public assistance programs. Certain practices are prohibited, such as coercion, fraud, or misleading statements. Texas generally requires that a life insurance policy be in force for at least 2 years before it can be viaticated. However, there are exceptions, such as terminal illness or other qualifying circumstances defined by law. Finally, Texas participates in the Long-Term Care Partnership Program. This program allows individuals who purchase qualified long-term care insurance policies to protect a portion of their assets if they later need to apply for Medicaid. The amount of assets protected generally corresponds to the benefits paid out by the partnership qualified policy. To qualify, long-term care policies must meet specific Texas and federal requirements, including inflation protection standards and consumer protection provisions. The key takeaway for the exam is that Texas recognizes partnership-qualified long-term care policies and offers asset protection incentives to encourage their purchase. Advertising and solicitation rules. Now let's talk about advertising and solicitation rules in Texas, because this is another area the state exam loves to test. In Texas, insurance advertising is regulated under a file and use system. That means advertisements generally do not need prior approval before being used, but they must comply with Texas law and must be kept on file in case the Department of Insurance asks to review them. Agents and insurers are responsible for making sure their ads are accurate, clear, and not misleading. Texas strictly prohibits deceptive or misleading advertising. This includes making false statements, exaggerating benefits, omitting important information, or using language that could confuse or mislead a consumer. Advertisements must clearly identify the insurer and the type of insurance being offered. Certain disclosures are required in advertisements, especially when discussing benefits, guarantees, or policy features. If something is limited, conditional, or subject to change, that needs to be made clear. Texas also closely regulates the use of the word free. You cannot advertise anything as free if it is directly or indirectly paid for by the purchase of insurance. If conditions apply, then it's not truly free and cannot be advertised that way. Testimonials are allowed in Texas, but they must be genuine, represent the current opinion of the person giving them, and not be misleading. You can't use testimonials that imply guaranteed results or benefits that the policy does not actually provide. Moving into marketing practices, Texas law clearly defines twisting and churning. Twisting occurs when an agent induces a policy owner to replace an existing policy by misrepresenting the terms or benefits of the new policy. Churning is a form of twisting, where an agent encourages repeated policy replacements primarily to generate commissions. Both practices are illegal in Texas. Rebating is another major exam topic. Texas generally prohibits rebating, which means offering anything of value not stated in the policy as an inducement to purchase insurance. This includes cash, gifts, or services tied to the sale of a policy. However, Texas does allow certain limited exceptions, such as small promotional items that are not contingent on buying insurance and have nominal value. Texas also limits controlled business. Controlled business refers to insurance written on the agent's own life, family members, employer, or business associates. This rule is designed to ensure agents are actually serving the public and not just insuring themselves or closely related parties. Texas has rules regarding business cards and stationery as well. Any marketing materials must clearly identify the agent's name and license status, and must not imply that the agent represents the Texas Department of Insurance or any government agency. Texas provides additional protections when marketing insurance products to seniors. These rules are designed to prevent confusion, pressure, and abuse, especially during in-home or one-on-one solicitations. Agents must be especially careful to use clear language and avoid high-pressure tactics. There are also specific appointment-setting rules when dealing with seniors. Agents are generally required to clearly explain the purpose of the meeting in advance and disclose what products will be discussed. Misrepresenting the reason for an appointment is not allowed. Certain products marketed to seniors also come with enhanced disclosure requirements and cooling-off periods. In many cases, seniors are given extended free look or cancellation periods, allowing them extra time to review the policy and change their mind without penalty. The key exam takeaway is that Texas places extra safeguards around senior marketing, and violations in this area are treated very seriously. Replacement regulations. Now let's talk about policy replacement, because Texas is very strict about how replacements are handled, and this is a high-probability exam topic. Under Texas law, a replacement occurs when a new life insurance policy is purchased, and, as a result, an existing policy is lapsed, surrendered, forfeited, assigned, converted, or otherwise terminated or reduced in value. Even if the existing policy stays in force for a short time, it can still be considered a replacement if the intent is to replace coverage. When a replacement is involved, Texas requires the use of a specific disclosure form called the Notice to Applicant regarding replacement of life insurance. This notice must be provided to the applicant at the time of application and signed by the applicant and the agent. The purpose of this notice is to make sure the applicant understands that they may be giving up valuable benefits by replacing an existing policy. The replacing agent has several duties under Texas law. The agent must ask the applicant whether they have existing life insurance, accurately record that information on the application, and provide the required replacement notice. The agent must also submit copies of the replacement notice and any related documents to the replacing insurer. The replacing insurer also has responsibilities. Once they receive notice that a replacement is involved, they must notify the existing insurer. This notification typically must occur within 5 business days. The replacing insurer must also maintain records related to the replacement transaction. The existing insurer has duties as well. After being notified of a proposed replacement, the existing insurer is required to make reasonable conservation efforts. Conservation means attempting to keep the policy in force by informing the policy owner of the benefits of their existing policy and the potential disadvantages of replacing it. This may include contacting the policy owner or providing comparative information. Texas replacement regulations are designed to protect consumers, not prevent replacements altogether. The key is transparency and informed decision-making. As long as all required steps are followed and the replacement is in the client's best interest, it can be done legally. Documentation is a big part of replacement compliance in Texas. Agents and insurers must keep copies of the replacement notice, applications, and any related correspondence. These records must generally be retained for at least 5 years and must be made available to the Texas Department of Insurance upon request. For the exam, remember that Texas replacement rules focus on disclosure, documentation, and conservation, with specific forms, defined duties, and strict timelines. Policy delivery and free look period. Now let's talk about policy delivery and the free look period, because Texas has very specific rules about when coverage begins and when a policy can be returned. In Texas, proper policy delivery means the policy must be delivered to the policy owner either in person or by an acceptable electronic or mail method, depending on how the policy was issued. Delivery is important because it often affects when coverage becomes effective and when the free look period begins. Texas may require a delivery receipt or acknowledgement, especially when the policy is delivered in person. This receipt helps document that the policy was actually delivered and that the policy owner had the opportunity to review it. Delivery can be either conditional or unconditional. Conditional delivery means coverage depends on certain conditions being met, such as payment of the first premium and the insured being in the same health as stated in the application. Unconditional delivery means the policy is delivered and coverage is in force without additional conditions. For exam purposes, it's important to understand that coverage does not automatically begin just because a policy is issued. Proper delivery and any required conditions must be satisfied. Once a policy is delivered, Texas law provides a free look period, also called the right to return. The standard free look period in Texas is typically 10 days. During this time, the policy owner can review the policy and return it for a full refund if they decide not to keep it. Texas provides extended free look protections in certain situations. For many products sold to seniors, the free look period is extended to 30 days. Long-term care insurance policies issued in Texas also come with a 30-day free look period, regardless of the applicant's age. Free look rules still apply in replacement situations. Even when a policy is replacing an existing policy, the policy owner must be given the full free look period to review the new policy before being locked in. This gives the consumer an extra layer of protection during replacements. If a policy is returned during the free look period, Texas requires a full refund of any premium paid. This includes any fees or charges associated with the policy. From an exam standpoint, the key takeaway is that the free look period is a consumer protection rule, and Texas enforces it strictly. Texas claim practices. Now let's cover Texas claim practices, because knowing how claims are handled is a key part of the Texas-specific exam. Texas law requires prompt payment of claims. When a claim is submitted, the insurer must acknowledge receipt within 15 days. If additional information is needed to process the claim, the insurer has a set period to request it, giving the policy owner clear guidance on what's missing. Once proof of loss is received, Texas generally requires payment within 5 to 15 days, depending on the type of claim. If the insurer fails to pay on time, interest penalties may apply, so insurers have a strong incentive to handle claims promptly. Texas also defines unfair claim settlement practices. It is illegal for insurers to misrepresent policy provisions, make promises they don't intend to keep, or fail to adopt reasonable standards for investigating and settling claims. Insurers are expected to follow proper claim procedures, including timely investigation, clear communication, and acting in good faith toward the policyholder. Missteps in this area can result in enforcement action by the Texas Department of Insurance. Beneficiary provisions in Texas have a few unique considerations. Texas is a community property state, which can affect how death benefits are distributed between spouses. Policies may also include facility of payment provisions, allowing the insurer to pay benefits to someone other than the named beneficiary if the beneficiary is a minor or cannot be located. Finally, Texas has rules for unclaimed benefits. If a death benefit remains unclaimed, the funds may eventually be turned over to the state as unclaimed property. Insurers are required to make reasonable efforts to locate beneficiaries before submitting the funds. The key takeaway is that Texas law emphasizes prompt payment, fair claims handling, and protections for beneficiaries, especially in cases involving community property or unclaimed benefits. Privacy and consumer protection. Now let's cover privacy and consumer protection in Texas, which is another area that's unique compared to the general life insurance exam. Texas has specific privacy laws that insurers and agents must follow. Policy owners must receive clear notice about how their personal information will be used and shared. In most cases, consumers have the right to opt out of having their information shared with third parties for marketing purposes. Texas also limits how insurers can share medical or financial information, going beyond federal HIPAA protections in some areas. This means agents must handle medical records and other sensitive information with extra care, and only share it when legally allowed. Texas also provides a Consumer Bill of Rights for insurance buyers. This gives consumers the right to clear information about their policies, including benefits, costs, and any restrictions. It also establishes formal complaint procedures. If a policy owner believes an insurer or agent has acted improperly, they can file a complaint with the Texas Department of Insurance, which investigates and enforces compliance with the law. Suitability is another Texas-specific requirement. Agents have a duty to know their customer before recommending a policy or annuity. This means assessing the consumer's financial situation, needs, and objectives. Agents must document how a recommendation is suitable for that particular client. There are special rules for sales to seniors and for annuity products, which often carry extra disclosure requirements and stricter suitability standards to prevent abuse. The bottom line for the exam is that Texas law emphasizes protecting the consumer's privacy, ensuring they have the right information, and making sure recommendations are appropriate for their situation. Agents who fail to comply with these rules can face penalties, so the state takes this very seriously. Producer conduct and ethics. Now let's dive into producer conduct and ethics in Texas, because this is another area that the state exam focuses on heavily. Texas agents have fiduciary responsibilities, which means they must handle premiums and client funds with the highest level of care. All premiums collected on behalf of an insurer must be placed in a trust fund. Commingling personal funds with client premiums is strictly prohibited. Agents are also required to maintain accurate accounting records and remit premiums to the insurer in a timely manner. Failure to do so can result in fines, license suspension, or even criminal charges. Texas law also clearly outlines prohibited practices. Rebating is generally prohibited, which means agents cannot offer gifts, discounts, or any other inducements tied to the sale of a policy, except for specific limited exceptions allowed under Texas law. Twisting and churning, replacing policies unnecessarily, or misrepresenting benefits to induce a replacement, are also illegal. Other prohibited practices include misrepresentation of policy terms, defaming competitors, engaging in unfair discrimination, and using unfair marketing practices. The goal is to protect consumers and maintain integrity in the insurance industry. Appointments are another key area. In Texas, an agent must be appointed by an insurance company before they can legally transact business on that company's behalf. The insurer files the appointment with the Texas Department of Insurance. Appointments can also be terminated either by the insurer or by mutual agreement. If an appointment is terminated, the company must notify the department within 30 days. Agents cannot legally continue to sell policies for a company without a current appointment. Finally, commissions are tightly regulated. Commissions may only be paid to properly licensed and appointed agents. Agents may receive renewal commissions on policies as long as they maintain their license and appointment. Commissions can be assigned to another licensed agent under certain conditions, but sharing commissions with unlicensed persons is strictly prohibited. Doing so can result in serious disciplinary action. For the exam, the key takeaway is that Texas emphasizes honesty, fiduciary responsibility, and compliance. Agents are expected to handle client funds properly, avoid prohibited practices, maintain appointments, and only receive commissions in accordance with the law. Texas-specific policy provisions and requirements. Now, let's cover Texas-specific policy provisions and requirements, which are frequently tested on the state portion of the exam. Texas requires certain notices to be included with life insurance policies. When a policy is replacing an existing one, the replacement notice must be provided and signed by the applicant and agent. Policies sold to seniors may require additional notices explaining benefits, costs, and consumer rights. Long-term care policies, especially those under the Texas Partnership Program, must include notices about asset protection, rate increases, and any conditions that could affect benefits. Texas also has specific rules regarding HIV testing. Before an insurer can request an HIV test, the applicant must provide written consent. This consent must clearly explain the purpose of the test, how results will be used, and the applicant's right to confidentiality. Accelerated benefits, also called living benefits, are another area with Texas-specific requirements. Texas allows policies to include accelerated death benefits that pay part of the death benefit if the insured has a terminal illness or meets other qualifying conditions. Insurers are required to provide clear disclosures about these benefits, including how they work, any impact on the death benefit, and any potential tax implications. The policy owner must fully understand these benefits before accepting them. Finally, Texas strictly prohibits stranger-originated life insurance, or STOLI. A STOLI policy is one where someone with no insurable interest in the life of the insured encourages the purchase of a life insurance policy for investment purposes, often with the intent to sell the policy to a third party. Texas law considers these arrangements illegal. What makes a policy STOLI under Texas law is any scheme where the policy is taken out primarily for the financial benefit of someone who is not a family member or business partner with an insurable interest, rather than for the protection of the insured or their legitimate beneficiaries. Agents and insurers must be careful to identify and avoid STOLI transactions. For the exam, remember, Texas requires specific notices, regulates accelerated benefits carefully, and prohibits STOLI to protect consumers and prevent abuse. Penalties and enforcement. Now let's talk about penalties and enforcement in Texas, because understanding the consequences of violations is an important part of the state exam. The Texas Department of Insurance has broad authority to take administrative actions against agents and insurers who violate the law. These actions can include suspending a license, revoking a license entirely, placing an agent on probation, or issuing a cease and desist order to stop illegal activity. Administrative actions are intended to protect consumers and maintain integrity in the insurance industry. Texas law also allows for civil and criminal penalties. Civil penalties can be imposed for violations like misrepresentation, rebating, or failure to comply with record-keeping requirements. The amount varies depending on the severity and nature of the violation. Criminal penalties are reserved for serious offenses, such as fraud or intentional misappropriation of funds, and can include fines and imprisonment. In many cases, Texas law also requires restitution, which means the agent or insurer must repay any money improperly obtained from policy owners or claimants. There are specific grounds for disciplinary action in Texas. These include providing false or misleading information on an application, misappropriating premiums or other client funds, being convicted of a crime that reflects poorly on honesty or trustworthiness, and failing to pay child support. Even if the violation doesn't involve insurance directly, it can still affect your license because Texas holds agents to high ethical and legal standards. For the exam, the key point is that Texas takes enforcement seriously. Licensees must follow all laws, rules, and ethical standards because violations can lead to suspension, revocation, fines, restitution, or even criminal charges. Understanding the scope of penalties helps you anticipate what the law expects and how the Department of Insurance protects consumers. Insurance Guaranty Association. Now let's talk about the Texas Life and Health Insurance Guaranty Association, or TLIHIGA, which is another area tested on the state portion of the exam. The purpose of the Guaranty Association is to protect policy owners, beneficiaries, and insureds if a life or health insurance company becomes insolvent. It acts as a safety net, making sure that people don't lose all their coverage if an insurer fails. Texas law sets coverage limits for the Guaranty Association. For life insurance, the association generally covers up to $300,000 in death benefits and $100,000 in cash surrender, or present value of policy benefits. Health insurance coverage has similar limits, but the exact amounts can vary depending on the type of contract. Not every policy or person is covered. The Guaranty Association does not cover self-funded plans, certain types of fraternal benefit societies, or policies issued by insurers that are not members of the Texas Association. Agents should be aware of these exclusions so they don't mislead consumers. The association is funded through assessments on member insurers. If an insurer becomes insolvent, the other insurers in Texas contribute to the association to ensure claims can be paid. This system spreads the risk across the industry rather than relying on taxpayer money. Agents must be careful about what they say regarding the Guaranty Association. You cannot suggest that coverage is guaranteed by the state, that the association protects all policies, or that it is a substitute for the insurer's financial stability. The association is a backup, not a primary guarantee, and overstating its role is considered a violation of Texas advertising and solicitation rules. For the exam, remember, the Texas Life and Health Insurance Guaranty Association protects policy owners up to specific limits, is funded by member insurers, excludes certain policies, and agents must avoid making misleading statements about its coverage. Special Texas Topics. Now let's cover some special Texas topics, because these are areas where Texas law adds requirements beyond the general life insurance rules. Texas provides specific protections for military personnel. Insurers and agents must follow extra rules when selling insurance to members of the armed forces, especially on military installations. Certain sales practices are prohibited, including aggressive marketing, misrepresentation, or any conduct that could pressure service members into buying coverage. These rules are designed to protect military personnel from exploitation. Fraternal benefit societies are another unique Texas topic. These are nonprofit organizations that provide insurance to members, often along with social or charitable benefits. Texas regulates fraternals and requires that their insurance activities comply with state law. Agents selling fraternal insurance must be licensed specifically to sell for that type of organization and must follow the society's rules and Texas regulations. Medicare supplement insurance also has Texas-specific rules. While federal law sets the baseline, Texas adds extra requirements for coverage and disclosure. Policies must meet certain benefit standards, provide clear explanations of coverage, and comply with Texas open enrollment rules. For example, Texas ensures that applicants have guaranteed issue rights during specific periods and cannot be discriminated against based on health conditions during those times. Pre-need funeral insurance is another Texas-specific product. This type of insurance is sold to cover funeral and burial expenses in advance. Texas regulates pre-need products strictly, including licensing requirements for agents who sell them. Insurers and agents must also maintain trust accounts to ensure that funds collected for future funeral services are protected and properly managed. For the exam, remember that these special topics, military protections, fraternal societies, Medicare supplement, and pre-need funeral insurance, each have unique Texas rules, licensing requirements, and consumer protections that go beyond the general life insurance laws. Record keeping and reporting. Now let's go over record keeping and reporting in Texas, which is another area the exam emphasizes. Texas requires agents to maintain accurate records of all insurance transactions. This includes applications, policies, correspondence, replacement forms, and any other documents related to the business they conduct. These records must generally be kept for at least 5 years, and agents are expected to organize them so they can be reviewed if the Texas Department of Insurance requests access. TDI has broad authority to audit or inspect these records to ensure compliance with Texas law. Agents must also report certain changes to TDI in a timely manner. If an agent changes their address, they are required to notify the department within 30 days. Legal name changes must also be reported promptly, along with supporting documentation. Criminal convictions are another reportable event. If an agent is convicted of a crime, they must inform TDI as part of their ongoing licensing obligations. Failure to report convictions can lead to disciplinary action. Finally, if an agent changes employers, such as moving to a new insurance company, that information must be reported to TDI as well. This ensures that the department always has current information on who is appointed to transact business in Texas. The key takeaway for the exam is that Texas law expects agents to maintain complete records, retain them for 5 years, and report address, name, employer, and criminal conviction changes promptly. Texas-specific exam tips and common pitfalls. Now let's finish up with some Texas-specific exam tips and common pitfalls, because knowing these can save you time and help you avoid mistakes on test day. First, memorize the key numbers. Texas exams often test specific timeframes, percentages, and dollar limits. For example, remember that the standard free look period is 10 days, extended to 30 days for seniors and long-term care policies. Replacement notifications usually must be sent within 5 business days. Community property rules, cash value limits under the Guaranty Association, and continuing education hours, 30 hours every 2 years with 2 ethics hours, are all numbers that can show up in questions. Be aware of concepts that are commonly confused. For instance, many people mix up twisting and churning, or rebating versus allowable promotional items. Know the difference between conditional and unconditional policy delivery, and between administrative rules and statutes in the Texas Insurance Code. Texas law sometimes differs from federal law, so pay attention to those differences. Privacy protections in Texas go beyond HIPAA in some cases. Long-term care partnership programs, pre-need funeral insurance, and fraternal societies have requirements that don't exist at the federal level. If a question includes a Texas twist on a general life insurance concept, that's usually a state portion question. Focus on the most frequently tested Texas topics: licensing requirements, replacement regulations, policy provisions for seniors and long-term care, claim handling, and producer conduct and ethics are all areas that appear regularly on the exam. Make sure you understand not just the rules, but the reasoning behind them, like why free look periods or replacement disclosures exist. Finally, know the key forms and their purposes. For example, the notice to applicant regarding replacement is required whenever a policy replacement is involved. Delivery receipts document that a policy was actually delivered. Consent forms for HIV testing or accelerated benefits disclosure forms ensure compliance with state law. Understanding what each form does and when it's required is often the easiest way to answer Texas-specific questions correctly. For the exam, the bottom line is focus on the numbers, know the unique Texas rules, understand common pitfalls, and be familiar with key forms. If you keep those in mind, you'll have a strong advantage on the state portion of the life insurance exam. That wraps up our Texas-specific life insurance exam review. We've covered everything that sets Texas apart: licensing requirements, policy provisions, replacement rules, claim practices, advertising and marketing regulations, consumer protections, producer ethics, and special topics like long-term care partnerships, pre-need funeral insurance, and fraternal societies. We also went over record-keeping, reporting, and key forms you'll see on the exam. For final study tips, focus on memorizing the important numbers, timeframes, and dollar limits. Understand the reasoning behind Texas rules so you can apply them in scenario-based questions. Make sure you know which forms are required and what their purposes are, and pay special attention to areas that frequently appear on the state portion of the test, like free look periods, replacement notices, and ethical conduct. The Texas Department of Insurance website is an excellent resource if you want to read the actual rules, check for updates, or download sample forms. Spending some time there can give you extra confidence that you're studying the most current material. Review consistently and don't skip over the forms and numbers. Good luck on your exam. If this video helped you, make sure to subscribe for more study guides, leave a comment with any questions, and share your success once you pass.